This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So this chapter deals with giving assurance on what's called prospective financial information. In other words, to do with the future. So we're looking at profit and loss budgets, cash budgets, capital expenditure plans, anything of that nature. First thing is that before we accept the engagement, and remember what I said on the last chapter, that we're very much on our own here. We have to line up, if you like, exactly the terms of our engagement through an engagement letter. We have to know how many years worth of budget we're going to be asked to give our opinion on. We have to know maybe how many group companies that we have to look at. We need to know the size of the job, in other words. We need to know who's going to be using this, so we have some idea of maybe our liability if something goes wrong. We need to know by when it has to be done. We need to be given assurance that the client will cooperate with us in providing all the information we require and give us sight of all the documentation that we need. So obviously a detailed letter of engagement, but before we even send that letter of engagement, we just need to have a look at this, let's call it budget, just to see what it's like. Because if we look at it and see it is clearly a work of enormous fiction, and just by comparing this year's budget, next year's budget to this year's actual, they're kind of doubling all the figures and so on, that there seems to be no real foundation for these changes and assumptions, then we should decline the appointment. What is the point in accepting an engagement if you kind of know that you're not going to be able to make any sort of useful assurance pronouncement to your client, and you're going to really be saying, this projection, this budget, this forecast, seems to be wrong on so many levels. So you would just avoid that problem by not taking on the job at all. However, if the assumptions look kind of reasonable and the results look as though they could be, the schedules they produced are suitable for the intended use, then we will get down to negotiating the detailed letter of engagement and the terms of the engagement. How do we verify future expenditure? How do we can never quite verify, but how do we get some assurance that it might, if not be right, at least not be obviously wrong? And the main method is really analytical review. So if they made, if sales were gently increasing last year, about 1% for each month, then we would kind of be expecting maybe them to be increasing 1% each month for the forthcoming year. They might not, of course, but you would certainly be alarmed if they had increased the rate of sales increase to 5% per annum. If you saw that the normal receivables days last year was 50, and this year they put them in at 30, then you think, well, how come they've managed to cut 20 days off the debtor's payment period? Have they done that just to speed up the what looks like the cash receipts and to make the cash flow forecast look better? Or if you find the gross profit percentage has increased from 60% to 80%, you think, well, how on earth has that been done? I mean, that's a bit of magic to be able to do that. So analytical reviews are terribly, terribly important. They are the single most important weapon, if you like, for looking at prospective financial information. If the prospective financial information falls roughly in line with what you might expect, then it's going to give you some comfort. The other thing we can do, we can look at kind of subsidiary budgets. So if we're thinking of building a factory, then bringing it into operation, creating some profits from that, and so on. Then there's going to be some sort of capital expenditure budget. How do we know when the money is going out? Because that's important. So you'll be going back to looking at maybe contracts with the builders and so on, and telling you when the money is going out. And you'll be looking at when the builders say that the factory should be finished, and then maybe other suppliers saying when the machinery is moved in. And then you say, well, it looks as though we might be able to begin producing in 18 months' time, and that's when the first revenue is going to be kind of starting to arise. So verification of any contracts they have, any projected expenditure, any agreements they've made with people to make sales and the like can also be important. What we're looking at is the assumptions made by the client, maybe about growth, maybe about gross profit percentages, maybe about cutting expenses, maybe about the expense of putting up this factory, because capital projects, of course, have a habit of overrunning considerably and also being delayed considerably, which is really going to mess up your cash flow. You'll be looking at evidence, like looking at contracts with the builders, which says it's going to be finished, in March in 18 months' time, or whatever the timeline is going to be. Evidence of what the price is going to be, what the stage payments are going to be, maybe what the contracts for selling your produce is going to be. Maybe you can see some selling prices that have been agreed already. Does it look reasonable? Or is it something which seems to be based on astonishing optimism, that we will finish this on time and we will begin selling on time and we will keep the costs of this, and in your own experience you think this is very, very unlikely. And consistent really with what they'd managed to do in the past. So if expenses, if wages are a certain proportion of sales, then you kind of expect wages to stay that proportion of sales, and so on. If the rent of the factory has been 50,000 last year, you don't particularly expect it to fall down to 30,000 this year if it's the same factory. So we can tell a lot by the kind of patterns that we're looking at there. If you're given some sort of, let's say, cash flow forecast and asked to describe the work you would do, remember to question everything. Everything on that cash flow forecast is an estimate. So you would check the opening cash. That's one thing. It isn't an estimate. But then you can question and ask for evidence on the sales figures. Why that volume? Why that selling price? You compare it to last year's. Why do you think it's increasing at 2% for every month, and so on? So you question the sales volume, you question the sales price. Then what you can do is you can question the timing of the receipts. So you look to last year's receipts and you say, looks like 60 days. And into their cash flow forecast they put 30 days. Why has that happened? And even if they put in 60 this year, the same as last year, you should say, okay, they put in 60 again, but are we sure that the pattern of the customers hasn't changed? If there are more export customers, it takes the goods a while to get there and foreign currency to clear and so on. Maybe they should be pushing up the collection period from 60 to 70 days. You can question the costs. You can question the rate of inflation which has been applied to the various costs. You can question the gap between getting a supplier's invoice and paying for that. You can question the adequacy of the capital expenditure budget. You can question the tax charge and when it has to be paid. You have to remember to put in repayments of the loan. If they're doing us a loan, you have to put in repayments or the charges of interest. That's something that's very frequently forgotten in cash flow forecasts, when the loan is repaid and when the interest has to be paid, because it's coming out of your current account to do that. You can be questioning maybe the levels of staff. So if you're putting in a new production line but the wages stay the same, you should be thinking, How is this being manned? Who's actually working this production line? Absolutely everything on the face of any sort of budget is open to estimation, and therefore is open to you probing and looking for evidence as to why that figure is correct. And of course, it'll be normal to do a kind of recalculation just to make sure that the additions are all fine. And just because it's done on an Excel spreadsheet doesn't mean that the answers are right. They depend on the assumptions, but they also depend, of course, on the equations. And there have been quite serious incidents of budgets and cash flows being wrong simply because the wrong formulae were put in the spreadsheet cell. So the more kind of scientific, technical approach doesn't mean it's going to be any more reliable. The opinion we give is going to be negative assurance or limited assurance there. It's going to be really saying whether or not the assumptions seem to provide a reasonable basis for the prospective information. There's nothing outrageous or unsupportable about them in any sort of way. Has it been properly prepared? Has it taken in the interest payments on the loan, and the tax payments are in there, the capital expenditure payments are in there, the directors' bonuses are in there, impinging on the cash flows and so on? And are there any doubts or warnings about the achievability of the results? Like if the building is delayed for 3 months, what's that going to do to the cash flow pattern? If the sales are maybe 10% lower, or the prices are 10% lower than we anticipate, what's that going to be doing to our cash flow? Are these prices kind of realistic? Is the date for starting the revenue coming in also basically achievable? So again, we're applying professional skepticism. Just because somebody's written something down and is full of optimism and hope that their project will work doesn't mean or won't cause it to work. And we have to scratch away looking for evidence that the prospective financial information has been properly and reasonably prepared, and that the results do seem achievable.